Friends, in this video for I Thought Wealth, I am going to talk to you on the topic personal investing versus professional investing. As an investor, one carries a certain set values, our beliefs are all well established, there is an investment style, there is an investment philosophy. When an individual investor becomes a professional manager, then he may be managing a product or a style quite different from his personal style. So, in the case of many people, I find that their personal investing is very different from their professional investing. Even people who talk very strongly on a certain investment philosophy or set beliefs and achieve very successful products do something very different in their personal investing. A friend of mine and someone whom I have always looked up to always told me that this is not a great idea, and I tend to buy into his advice. Interestingly, I bought into this advice a very long time back, much before I became a professional investor. So, when I decided to become a professional investor, my set of beliefs was that I should take what has worked for me and try to make it work for others. Now, I have been a thematic and a small cap investor for the best part of my investing years. How can I make it work for my clients or somebody who is going to trust me with their money? This was the question that was before me before I began. The answer for this was not so easy, and let me tell you why. A small position which you need to buy for yourself can be easily bought with low impact cost. But when you buy for, let's say, 500 people, how do you manage to achieve the same thing? There is no question that you need to achieve it. Many people say, oh, when the returns are very good and when you are right by miles, impact cost doesn't matter. As an investor, I am personally very conscious of impact cost, and I want to be just as conscious in whatever investing I do. How does it matter whether I am investing for myself or for others? The principle should be the same. So, that makes it doubly difficult. This is why I first began in the product space. We started doing professional investing in the mutual fund space. That was a place where the impact cost at the unit level could be controlled. So, if I think the markets are low today and the NAV is going to be less, then on that day I can advise my clients to put a lot of money, and if they get in on time, then they get the advantage of a lower unit NAV. By doing that, we are able to not just control the impact cost, but actually turn it into their favor. You know that fund managers in the same mutual fund schemes don't have that luxury, but I felt that I could meaningfully deliver that luxury to the investor. For a long time, investors never understood why an investment needed to be broken down into multiple tranches. Why did we have to make more decisions? Why did a team need 5 or 6 installments of investments? They were saying, if I invest through a bank, I just put my money in one day. Why are you making it so many transactions? Why should I go in and do so many transactions? Why can't I just do it in one transaction? The problem is that the decisions are made keeping in mind the valuation and what is right for the portfolio to succeed. At the individual investment level, you need to focus on buying right. You need to buy at the right valuation, and when that valuation becomes even more favorable to you, you need to buy more. This is exactly what I had done at the stock level. So, when it came to the mutual fund level, I believed that this is the best way I could make a meaningful contribution to others. It was a clear decision, and that decision worked. If we are able to generate slightly better returns, it is only because we advise clients to buy when the valuations are in his favor, NAVs are lower, and they are able to get into the same products at a lower valuation than others are getting into. When you do that consistently and constantly for your clients, what happens is that you are able to bring in the same sharp focus which you do in your investing in small or micro cap stocks. So, wherever you are doing it, the principles are the same. So, when we manage to do this in fund investing, we were really happy that we were not adding impact cost to the client. This also has a very important meaning to what you get paid, because if you are able to save costs for the client at every step of the way, then the justification for claiming an advisory fee from the client is simpler. If you are not able to do that, then you cannot do that. Having said that, we would have possibly done it with most of the clients who are willing to buy when the valuations are in favor, but there will always be people who don't want to invest when the chips are down. When the chips are down, they are more worried about their returns and whether the portfolio has delivered and stuff like that. But in a crisis like the Ukraine crisis or in the previous crisis, you know that these things will blow over a period of time. So, the opportunity thrown at you by the market must never be wasted, because you are buying a theme based on your conviction in that theme. This is exactly what you do in a stock also. You are already convinced on the stock and the stock becomes cheaper. What do? You buy, right? So, the same thing should be done even in a thematic fund. So, if you do that, then when the market misprices the theme, then you are getting in. Now, some investors may choose not to get in. They tend to perform in a way which they don't like, but then they also refused to act when the opportunity was in their favor. In such cases, it becomes very difficult for you to do anything. In my own portfolio, if I bought a stock at 80 rupees and it comes to 65 rupees, and I have also done a lot of homework to understand that it was cheap at 80 in the first place, it is much cheaper at 65. I should buy a little more. I should give myself room to add to that position. And that in essence is what has been the broad principle which I have applied in building individual positions in a portfolio, whether it is as a personal investor or as a professional investor. This principle is always overarching and runs in every decision. So, we are not worried that the first position was at the wrong time. We are more worried whether the subsequent positions have been done. Suppose the subsequent additions have been made and the position sizing has been adjusted to the level we are comfortable with. Sometimes we may be more comfortable and we may get more convinced and we want to increase the position size. In that instance, we need to also achieve that. In all this, our conviction keeps moving with the moving valuation, with the moving NAV in the product and with what market thinks about it. So, we are always thinking, why is the market viewing this product like this and why are we viewing the same product differently? And we try to weigh these two things to understand whether our conviction will stand the test of time. When we are convinced that our conviction will hold ground, then we don't hesitate. We would like our investors to buy on our advice and take their positions into a bigger size. They can achieve better position sizing. Whether it is in personal investing or professional investing, achieving position sizing is super critical. If you are able to do it in 3 or 4 of your large bets, then you are home, because if the bet pays off in due course, then you are going to get the returns which you should get for owning that theme. Many people who have contributed have achieved that. The few people who have not contributed have in general achieved suboptimal outcomes. The simple reason is their position sizing was inadequate, whereas somebody else had a better position sizing. Two people owning the same asset have very different outcomes. The one who has shown better conviction tends to do better. So, this has been my experience. As a personal portfolio decision also, this position sizing is super critical for me, and whenever I have managed to increase my position when the valuation is in favor, that position has performed to potential and made me feel good about the conviction I showed when the valuation was wobbly. Effectively, when you are doing investing, whether personally or professionally, you don't wear different hats, you wear the same hat and you ensure that investors who want your advice get the maximum out of it. But you cannot force an investor to buy, because the advisory models don't work that way. So, only if the investor approves the decision he can participate. So, you need to try very hard to convince the investors, you need to give them the time to understand why you are saying something. You need to make them appreciate the opportunity, and you need to ensure they participate in due course, because investment decisions have to be executed, and execution is a very significant part of an investment process. In an advisory business, execution is in the hands of the investor, and we need to ensure that that is also done to the benefit of the investor. Sometimes you tell somebody to buy something, they take 15 days, in 15 days the opportunity has gone. Then they cannot participate to the same outcome or benefit which somebody does in a timely way. So, the outcomes will change and the benefits will be very different. So, advice has to be executed, and you should make the investor do it just as well as you would do it. So, that in essence is a challenge for a professional manager or a professional advisor. In a professional capacity, you are limited by decision making. You are only going to advise, and the investor has to participate. So, when you advise yourself, you find the means to do what you believe in. When you advise others, sometimes they have to buy into the advice in reasonable time. So, though the thinking is the same, the outcomes tend to vary in a few cases. So, one cannot help it but accept it. It is like a doctor who has given a prescription that works to two patients with the same problem. One follows the procedure completely, the other does not follow. You are going to see a different outcome amongst these two patients, and as a doctor, you only hope that the other patient also changes and follows the prescription. Advisory is a prescriptive business. You have to understand that you cannot win in an advisory relationship unless the prescription is followed. Neither the professional investor wins nor the individual investor wins. So, both have to come on the same page. So, these are some of the aspects which do impact my professional investing, but these aspects are the core of my personal investing, and I hope that someday we are able to seamlessly do this for every single person. Today we do it for most of the people, but my mind always goes out to the people who haven't achieved that outcome, because having worked hard, you want everybody to get a good outcome, and that is something which we need to keep working on with the individual investors, and that is something we need to do as professional investors. It is our duty, and we need to keep trying as hard as we can. But overall, the conviction is the same, the way we make decisions is the same, the way we achieve scale is the same, the position sizing is the same, the themes we participate is the same, our outlook towards impact cost is the same, and we want winning to become a habit, which again is the same. So, it is not as if personal investing and professional investing are very different in terms of principles. The principles are the same, the process is the same, and we need to achieve a commonness and a oneness to achieve the same outcome for every one of us. Thank you for watching this video.